Now that Impervious Travel Mugs has calculated its variances for direct materials, direct labor, and their two different types of overhead, variable and fixed, they need to book these, and they're going to do so using the standard costing system in their journal. I typically book these always in the same exact order, the order that things would typically be added to inventoriable costs as they go through the period. The first one is we're going to record the purchase of direct materials that were purchased on account. Well, let's put this on December 31st. What's happening here? Well, we need to put the direct materials on the books. So firstly, I'm going to increase the value of that asset account by debiting direct materials inventory. Could be raw materials inventory dash direct, could be another way to call this, for the amount that we're putting on the books. We're using a standard costing system, which means when we put it on the books, we put it on at what should have been according to our standards. Well, if we go, when it equals to our variances over here, the numbers that we have under direct materials is if we hit our actual quantity that we purchased, but we only had to pay our budgeted price, we would have paid $46,500. Well, that is, for the purchases part of this, what should have been. If we hit our standard in this case that we set forth, we should have spent $46,500 and therefore put that much into our direct materials inventory account at the time of purchase. I'm going to skip a line and go down to the third line. We purchased these on account. So I'm going to credit accounts payable, increasing that liability. When we put this liability in the books, we don't owe the people that we bought these from at the rate of what should have been. We owe them the actual amount that we paid for it. So if we go back to our variances and we hit equal over here, the actual cost of our direct materials was $44,950. So that is how much we're going to put our actual accounts payable on the books for. Well, my debits don't equal my credits right now. And you know I need another credit because our credit's smaller than our debit. What is my credit going to have to be for to get our numbers to balance on our two sides? Well, I take my debit and I subtract out my existing credit and I see I need a credit of $1,550. Is that number familiar? It is. It's the actual amount that we paid less in price from what should have been had we paid our budgeted price. It's our direct material price variance, which is favorable. And like all favorable variances, it should be credited in a journal entry. So the thing that's going to make our debits equal our credits in this entry is a credit to a transitional account for our direct materials price variance. And in this entry, we purchased direct materials on account. And now that we have those materials, I imagine Impervious used them in production. So we're also going to need a journal entry before we start making our books, etc. at period's end to account for the usage of direct materials during the production process in this given period. Well, when materials get used in production, they're inventoriable costs, so they need to go into WIP. So I know I need to increase the value of our WIP inventory account. And when they go into WIP, they're no longer sitting around in our storage, in our raw materials, if you will. So I know I need to credit direct materials inventory. So I'm going to skip a line and I'm going to start with that setup. We're recording at the amount that we should have put in there had we hit our standard. So I'm going to equal up here for my debit to WIP inventory. If I go back to my variances, I see that had we made the actual number of units that we made, 10,000 mugs, had we used as much material for each mug as we had planned, which when we look back on our standards, a pound and a half, and had we paid the budgeted price, we should have been putting $45,000 worth of cost into our WIP account. Like, had we hit all our standards, that would be the amount we would have had to put into WIP for the production of 10,000 mugs. Well, that's not what we have in direct materials inventory. It's not what we use. We see up above that we put $46,500 into direct materials inventory. That is what has to come out, because we didn't use as little as we thought we were going to, because we were a little inefficient with our materials during the period. We have a direct material inefficiency, if you will, unfavorable efficiency variance of 1,500, which is conveniently also what I need to make my debits equal my credits. So what's going to make my debits equal my credits is a debit for this unfavorable variance to our direct materials efficiency variance. And in this entry, we recorded direct material usage. Alright, direct materials is knocked out. Now we have to inventory the cost of direct labor during the period. So we're going to make another entry. Say it's on 12/31. We're inventorying it, so we're going to again need a debit to WIP inventory. And that debit to WIP inventory is going to be at the amount we should have put in to our WIP if we had hit our standards in terms of how long, in terms of labor hours, it was going to take to make each mug, and how much we had to pay for each labor hour our employees worked. And that amount, if I hit equals in our debit slot over here, is equal to the flex budget. That is our actual production level times our budgeted input quantity and our budgeted price. That's what should have happened. We should be putting $75,000 into WIP. It didn't happen though, and we know this because we have two unfavorable variances. We have a direct material price variance, or direct labor, price variance that's unfavorable, 1,028. We have a direct labor efficiency variance that's unfavorable of 2,100. Well, we need to put these things on our books. Since we're using a standard costing system, we know right now that the amount that should have been is not going to line up with the actual cost that we had to pay. So I'm going to go to my journal and I'm going to debit those two unfavorable variances like I debit all unfavorable variances. So we've got our direct labor price variance, which was unfavorable. We have our direct labor efficiency variance, which was also unfavorable. Now I can go back to my calculations and I can grab those two numbers. Our variance for direct labor price was unfavorable, 1,028. Our variance for direct labor efficiency was unfavorable, 2,100. And now that is going to line up in total. If we add that all up, it comes up to $78,128, which is the actual cost that we had. How did we pay this? Well, the information tells us that we're going to assume that $76,000 of these salaries and wages have been paid in cash, which means we need to reduce the value of that asset. So I'm going to start by crediting cash for that $76,000. And that the remainder of these wages that got inventoried or went into variances over here are still owed to our direct laborers. And that is going to be the salaries and wages payable entry. To credit our liability for the amount of salaries and wages that we owe. We just booked all three of these debits. You know we already paid $76,000 in cash, which means we must owe our employees $2,128 right now, and $76,000 plus $2,128 is $78,128. That is the actual cost that we had. So we've accounted for all of our inventoried labor costs in this journal entry where we recorded direct labor costs. Next up, we need to record our actual, big important word right there, actual variable overhead expenditures for this period. We are going to assume that these actual variable overhead expenditures were caused because Impervious travel mugs incurred $1,800 of variable depreciation, and then they paid a bunch of other variable overhead expenses, direct labor and direct materials, in the form of cash. So on 12/31, we're putting these actual costs into our manufacturing overhead pool. And the rule for manufacturing overhead is that actual overhead costs get debited to the pool. What was the actual amount of variable overhead that we had during the period? We have that information already. We'll use that on our variances. We actually incurred $20,960 of variable overhead during this period. Well, now we know that 1,800 of that is because of variable depreciation, so I'm thinking we should probably credit our accumulated depreciation account to increase the value of that contra asset for the amount of depreciation that was incurred during production during the period. That's 1,800. And that the difference between these two is for overhead expenditures, which were paid for in cash. Well, the difference between those two numbers is $19,160. That's the amount of cash we've had to transfer to pay for our indirect materials and our indirect labor, etc. We recorded our actual VOH expenditures. So now variable overhead has contributed $20,960 to the pool. Well, we got to allocate it out into inventory. We have our overhead on the books right now. It's got to come out of that pool and go into the cost of inventory. It's going into the cost of WIP, which means it's increasing the value of WIP, and WIP always goes up with a debit because it's an asset account. And it's got to come out of the pool. I'm going to go down to the bottom line. If actual costs go into the manufacturing overhead pool, if costs go in with the debit, they come out with a credit. Well, whatever went in has to come out. Like overhead is a temporary transitional account itself. It has to have a balance of 0 at the end. So if we put $20,960 into the pool for actual costs, all $20,960 has to come out. Well, what amount am I going to put into overhead? The amount that we allocated, or what amount am I going to put into WIP, excuse me, the amount that we allocated during the period, which we have on our calculations. We allocated $20,000 of variable overhead using this standard costing system, putting it in not at the actual cost rate or the actual quantity of the driver we used, but what the standards were for those two things. So we're going to put $20,000 of variable overhead into our WIP account, and our debits don't equal our credits or even close right here. And the reason for that is we have two variances for variable overhead. We had a unfavorable $400 variable overhead spending variance. Unfavorable variances get debited. So we're going to have VOH spending variance is our first debit, and that's going to be for the amount that we calculated in our calculations, which was $400. Variable overhead efficiency variance is also unfavorable at $560. So we're going to go and we're going to debit that account, VOH efficiency variance, for this $560. And now we've got $20,960 in total on both sides. We only put $20,000 into WIP using the standard costing system because that's what should have been, but that's not the actual amount of variable overhead we incurred because we both had to spend more in terms of rate, and we incurred more of the driver. We have two unfavorable variances related to variable overhead. And here we recorded the allocation of variable overhead into our WIP. A couple more entries left. The first one is for our other component of overhead, our fixed overhead. We're going to record the actual fixed overhead expenditures that we had during this period. We're going to assume that as a portion of this fixed overhead, $2,500 of our prepaid rent expired, $1,300 of our prepaid insurance expired, and that the remainder of our fixed overhead expenditures came in the form of cash. So on 12/31, we are putting costs, actual costs, into the pool. So manufacturing overhead is going to get debited to put those costs into the pool. This is actual. Well, what actual amount of fixed overhead did we incur? Our information tells us that the actual amount of fixed overhead that we incurred during the period was $23,800. Since that's the actual amount, that's what has to go into the pool. What was this for? Well, firstly, we had $2,500 of prepaid rent expiring. Prepaid expense accounts are all assets. Since some of it expired, we need to decrease that account, so I'm going to credit prepaid rent for $2,500. We had $1,300 of prepaid insurance expire. Again, it's a prepaid expense account. They all decrease on the credit side because they're all assets. And then the remainder of it had to be in the form of cash. So how much of that manufacturing overhead that was fixed was paid in the form of cash? Well, whatever makes our debits equal our credits. So this minus this means that we spent $20,000 in cash paying for actual fixed overhead expenditures. Salaried employees Who knows what else? We could be considering our utilities to be fixed. Whatever it was, we spent $20,000 in cash on it. We recorded our actual fixed overhead expenditures for the period. And now that they're in the pool, those costs got to come out of the pool and go into inventory. So let's record the allocation of our fixed overhead to WIP. So just like we started with the variable overhead one, we know we're going to need a debit to WIP because we're putting costs into WIP, which we took out of our manufacturing overhead pool. And since we're allocating from our manufacturing overhead pool, we know we need a credit to manufacturing overhead. Sorry about that. So this is the amount of actual allocation. What amount of fixed overhead did we allocate? We have that information. We did that calculation. We determined that had we hit our standards to make these amount of mugs that we actually made, we would have allocated $22,500. And since we're using a standard costing system, we flow costs through inventory at those standards that we set. But that's not the amount that's currently in the pool. Right now, there's $23,800 in the pool. As a temporary account, that has to get reduced to zero at the end of the period, so we need to credit that account for the same amount that we just debited it for in the prior entry. Our debits don't equal our credits. Why is that? Because we had variances. We've got two of them. We have a fixed overhead spending variance, which was $800, and we have a fixed overhead production volume variance, which was $500. They are both unfavorable. Unfavorable variances under the standard costing system always get debited. So we're going to have a debit to fixed overhead spending variance, and we're going to have a debit to fixed overhead production volume variance. The amount of our fixed overhead spending variance, according to our calculations, was $800. The amount of our fixed overhead production volume variance was $500. I'm going to bring that number over. And now we've got $23,800 worth of debits and credits. Our entry lines up. And in this entry, we recorded the allocation of fixed overhead.